Hello everyone, welcome to F&O University. I will be making series of videos on futures and options trading, and this is my first video, and I will be talking about the basics of futures trading. Okay, and my motivation for making this video came from my own experience and observation during the last couple of years. While trading in futures and options, I lost a lot of money, and I do not want the retail traders like you and me to be making the same mistake in the first year of their trading career, because the data suggests that almost 100% of the retail traders lose money in the market while trading in futures and options during the first year of their trading career. And if you have that much of money, if you can give that much of money to the market and then still survive, lots of new traders do not even survive into the market and they give up, they stop trading, right? I want retail traders to learn in advance so that they do not make those mistakes and reduce their losses as much as they can. Okay, so let's start with the very basics of futures trading. Okay, so what would be the content of this trading? I will be talking about the basic understanding of futures, what basic tools you require for trading in futures, what basic skills required to trade in futures, and where to study about options and futures trading. And last but not the least, what are the pros and cons of futures trading? Okay, so let's look at the basic definition, which is very much a bookish definition of futures trading. What does it say? Uh, it says that futures are derivative financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and set price. So, what does that mean? That you have a market view, right? For example, if you're looking for the market to go up, you can be a buyer. If you are looking for the market, or if you're looking for an asset to go down or go up, okay, you can take your bet accordingly, right? The future contracts are, there's a predetermined future date, so there's a predetermined future expiry date, okay, for every future contract. So every underlying asset, okay, will have three future contracts open all the time, okay, and there would be a predetermined future date, okay, and set price. So future date and set price. So let's look at this. So I will go into my ICICI Direct website and let's look at the future contract of SBI. Right, so if you see here, okay, by the expiration date, there are three contracts open. One is expiring on the 29th of April, that is the current month expiry, and you would have a next month expiry, which is 27th of May, and the far month expiry, which would be 24th of June. You will have a fixed lot size. If you want to buy a future contract of State Bank of India, you will have to purchase 3000 lot size, okay, multiplied by the last traded future price, which is 344.85 for the current month expiry. uh, if you want to, let's say if you want to buy a few, a State Bank of India in cash, and if you want to take delivery of that, you can buy even one share, right? So you can just pay 344 rupees, that's the spot price. So when you buy in cash, you pay the spot price, okay? So 344.30, That's the price you will pay if you want to buy a share of State Bank of India and take a delivery of that. But if you are looking to buy a future contract or even sell a future contract, let's say you have a bearish view, you want to you are looking for State Bank of India shares to go down in future, then you can even sell the future contract. So let's say here you are a bull and you have a view that State Bank of India shares will go up. Okay, so you are looking to buy the future contract, so you have to buy the whole lot, which is 3,000, and then multiplied by the last traded price. What is the amount that you would need to pay? You would need to pay a margin money. So what is the margin money and how is it calculated? So there's some calculation through which margin money is decided. We will not go in deep into that, but let's look at the margin money and margin amount. What is the percentage of margin that you need to pay for each underlying asset that you are looking to buy or sell in future? So let's look at SBI as an example. Okay, so what is the margin money so that you would need to pay if you're looking to buy April contract? The total value that you need to pay in percentage terms would be 35.17% of the total contract value. What is the contract value here? Contract value would be your lot size multiplied by the future price. So future price here is 336.3 and the lot size is 3000. So you would need to pay 35.5% of the total lot size. Okay, so let's calculate, right? What is the 35%? So 336 336.3 multiplied by 3000, right? So total contract value is 10 lakh 8,900 rupees. What is 35.17% of this? So 35.17, that is 3,54,830 rupees. This is what you would need to pay. And if you see, this amount is already mentioned here, 3,55,878 rupees. So there's some, because of some, maybe some decimal value, there's a slight change in the amount which is given in the Zerodha website. But overall you need to pay around 3,55,000 rupees if you're looking to buy a future contract of State Bank of India, right? Okay, let's move further. Okay, a future contract allows an investor to speculate on the direction of a security, commodity, or financial instrument. So, what do we mean by that? Speculation. So, let's look at the. Okay, so okay, right. So let's look at State Bank of India once again, right? So, what speculation we can do by looking at the future price of State Bank of India? Where is the future price? So here, these are all future price mentioned here. Okay, so 344.85, 346.30, 347.50, right, for each month contract. And what's the spot price is 344.30. So if you see, the future price is actually, even for the current month, okay, it is trading at a premium of the spot price. So what do we mean by premium? It means that it is trading at higher price than the spot price. What does that mean? That means that State Bank of India shares will possibly go up. Obviously you have to look at lots of other indicators as well. You need to do lots of other analysis. You need to look at the chart, contract, open interest. You need to do lots of things before you decide on whether you want to buy or you want to sell, right? But looking at the future contract, it looks like that it is trading, future price is trading at a premium, which means that possibly uh, State Bank of India shares will go up in future. Okay, but it's not that easy as you know as such. So just by looking at future contract, you cannot decide whether you want to be a buyer or a seller. There are lots of other permutation and combination that goes into this. Okay, so let's look at the other point. Okay, so futures are used to hedge the price movement of the underlying asset to help prevent losses from unfavorable price changes. What do we mean by this? Okay, futures were originally created actually for hedging purpose only, right? Let's say earlier when you had bought, let's say, State Bank of India shares in cash. Okay, you may have paid some amount, some money, and had bought about 2,000 shares of State Bank of India, right, at whatever price. Now you see that suddenly there's a news, and you see there's a bearish news, and you see that the State Bank of India shares might go down, so you have a bearish view now. So instead of selling your shares in cash, what you do, you take a bet on bearish bet on futures contract. Okay, so what we can do here is we sell future contract of State Bank of India, right? So we can decide to sell it on the market, and then I'll click on sell. Then it will give me the total detail of the contract, estimated order value, expiry date, the validity of the order, stop loss trigger. I haven't put any stop loss here. Quantity 3,000 shares, which is one lot. Order type is market, and last traded price is 344.85. Okay, so that's the uh, before I proceed, that's the it shows me that that's the total contract value, and I have a bearish view. What I'm doing here is I'm selling. So instead of buying, because I have already bought this in cash, so now I have a bearish view, so I buy. So what I'm doing here is I'm hedging. Okay, so I'm, instead of selling my shares, I'm hedging on State Bank of India future price. Okay, right. Okay, let's see. So introduction to future contract, we have already seen future contract, how exactly that looks like, but let's look at that once again. Okay, how future contract, underlying asset as an example. Okay, State Bank of India we have already seen. Let's see some other. Okay, let's look at Naukri.com. So for Naukri.com, again you will see there are three contracts open: current month, next month, far month. Lot size remains the same, 250 shares. Okay, what is the percentage of margin that you need to pay? These are the percentage mentioned. And what is the amount that you need to pay for margin? 3 lakh, which is 3,52,013 rupees for current month. If you want to buy it for the next month, you need to pay 3,53,081, and for month you would need to pay 3,53,882. So let's look at one more contract. Okay. Okay, let's look at Infosys. Okay, so Infosys, uh, total lot size is 600 again, right? That's fixed. Again, the expiry date would be fixed. Okay, 29th April, 27th May, and 24th of June, which is current month, next month, far month, and you will have a different margin value for each underlying asset. For Infi, you need to pay 20.75 for the current month, next month 20.73, and far month 20.89. Okay, accordingly it is calculated as this is the margin amount calculated for each month. Okay, and this is the last traded future price for Infosys, right? Okay, lot size, we have already seen that every underlying asset would have a different lot size, right? Okay, let's see. Let's look at Nifty. Where is Nifty? Here, you see Nifty. If you want to buy Nifty, again, lot size is 75, 75, 75, right? So we were looking at lot size, and this is the lot size for Nifty. Okay, what's the contract value? Contract value is your lot size multiplied by the last traded future price of that particular underlying asset. So here in Nifty, 75 would be the lot size. You multiply this with the future price of Nifty, which is 14,338.6, and that would be the total contract value. You do not need to pay this much amount. You only need to pay 14.66%, which is 1,57,000. But total contract value is this much, your last traded future price and your lot size, right? What is the margin? We have already discussed that. That margin is for every underlying asset you will have a different margin requirement, like we can see here in this page. For Nifty, you need to pay 14.66%. For Nestle India, you need to pay somewhere around 18%. For Naukri.com, you need to pay around 28 to 29%. For National Aluminium, you will need to pay 31.5%. So that's how margin is taken. Expiry, we have already discussed this, that it is the last Thursday of every month. And if it is uh, if last Thursday is a holiday, what happens on that? Then the expiry will happen one day before that. Okay, if last Thursday is of that particular month is a holiday, then the expiry would be one day before. Okay, open interest, you can see future open interest. What is open interest? Open interest means number of contracts open, okay, for that particular underlying asset, and that shows your open interest. Okay, so let's understand future open interest for Nifty 50 for the month of April and May expiry. You see the blue bar here. This is the total future open interest for each day mentioned at the bottom. Okay, so for, let's say for example, for 26th of April, what is the total open interest? So I can see here it is mentioned that total open interest for the 26th of April is 12 million. So what does this mean? 12 million. So 12 million, are these all sellers or are these all buyers? No, these are not all sellers, nor are they buyers. They are mixed. So some of them would be buyer, some of them would be seller. That's the total open interest which is open for 26th of April. And you see the open interest keeps changing every day. Okay, So for example, on the 16th of April, you see the total open interest was 16th of April, but on the 26th of April, you see the total open interest is 12 million. Okay, right. So this is open interest all about. Let's see what else do we have. Okay, so what are the basic tools required for futures trading? You require just two basic tools: demat account, and you need to have margin money to be able to trade in futures. What basic skills required for futures trading? You need to have basic understanding of derivative segment, which is futures and options. Okay, you can read that. I will show you in the next slide where exactly you can read about futures and options. You need to have some exposure to trading in options before you start trading in future. Why I say that? Because uh, your capital exposure is very high in future than options, so your risk is very high. Similarly, if if your risk is high, means you can gain very high and you can lose very high as well. Okay, so let's see this as an with an example. Okay, right. Okay, so you see, I have opened a future contract for SBI for 29th April expiry. I will be looking to buy one lot at 344.7 rupees. What is the exposure that I have? Capital exposure. So I'm paying 3.63 lakh rupees here as margin money. My profit is unlimited, right? But what is my loss? My loss is capped, but it is how much? It is 10.34 lakh, right? So I can gain a lot, but I can lose also a lot. But what happens if I buy SBI contract in option? So let's say I buy one lot at 4.65, which is at the money 345 rupees. So same price, almost same price that was trading in future, 345 rupees, right? Uh, because the option price at the money price is very low, it's 4.65, right? What is the total exposure that I have? The total exposure that I have is only 13,950. So if my view doesn't go in the right direction, if I, let's say if I'm bullish and I'm looking to buy uh, a call of SBI, because I'm bullish, I'm buying a call. If I am bearish, what I would do, I would buy put, but I will talk about this later in my next video. Uh, Here, the total exposure that I have is only 13,950 rupees. So I would lose this much of amount if my view doesn't go right. Right? Okay. Okay, directional view through technical analysis. You need to have some directional view through technical analysis and chart reading. You need to know a little bit of chart reading and a little bit of technical analysis, that you should be able to know, how to uh, draw, your resistance level, your support level. You need to know a little bit of, you should be able to identify a few candlestick that would help you in making a directional view. So this is it. And okay, where can you study about futures and options? You can study about futures and options on Zerodha. It's a very good website. I would say Zerodha Varsity. There are lots of information available on everything about trading related to futures, options, anything that you want to trade on. Then you have another very good website, investopedia.com, and then you have Kotak Securities as well. That's also a very good website for learning on futures and options. Okay, you can also watch a few videos on YouTube I'm not sure what language are you looking to watch it on, but if you're looking to watch it in Hindi, I would say you can watch Z Business F&O Ki Pathshala. That's a very very good YouTube channel for learning in options and futures. Okay, what are the pros and cons of futures trading? So let's understand the pros and cons so you can decide whether you want to be a future trader or not, whether you want to trade in futures now or whether you want to learn it first and then trade in futures and options. Okay, so let's understand what are the pros. So the pros are it gives traders an efficient idea of what the futures price of a stock or value of an index is likely to be, right? So what do we mean by that? That it gives us some idea that where it is moving. If this underlying asset is trading at a premium, that means the future price would probably be a bit higher. It is likely to go higher. If it is trading at a discount, which means that the future the stock price or the index price would possibly go down. Again, it doesn't mean that we start trading just by looking at the future price of index or any stock. Obviously you have to do lots of other technical analysis, chart reading before you start trading. Okay, since it is based on margin trading, it allows small speculators to participate and trade in the futures market by paying a small margin instead of the entire value of physical holding. Just as we discussed, you just need to pay a little bit, little margin, right? Here, like in this page, we discussed that for national aluminium, how much margin that you need to pay is 31.55% of the total contract value only, right? What are the cons? Lack of knowledge in derivative segment amongst participants could lead to losses. So if you are not knowledgeable about derivative segment, you could incur huge losses in this particular segment. So trading in future and options could be very very risky, especially futures is highly risky, not advisable till the time you have got some exposure into the market. So do not start trading in futures if you are just beginning your trading career. You are just 6 month 1 year old. I would say spend at least 1 year into the market, then think of trading in futures. Very high capital exposure could lead to big losses. As we saw here in the State Bank of India example, our exposure is very, very high, right? As a reason, right? Let's see what is the exposure. So our exposure is almost for 3.63 lakh rupees. While buying an option contract, I pay only few thousand rupees. Here I'm paying few lakh rupees. So my capital exposure is very very high, which means my risk is also equally very very high. Okay, brokerage fee again could cut your profit or could make your loss bigger than they actually are. uh, okay, so let's say State Bank of India, sorry, not State Bank of India, let's say ICICI Direct charges you some amount, which is, let's say, 0.25%. So let's calculate this, okay, to understand what is the brokerage that you pay. Right. So lot size is 3000. Let's say State Bank of India is trading at 345. That's the future price. Brokerage is 0.25%. Okay. What is the brokerage cost that you would be paying? You would be paying 2,587 rupees. So this much amount. So this is very high brokerage that you pay because your contract value is very high, almost like 10 lakh rupees when you buy, when you enter into the contract, and you pay the same amount when you exit the contract. Okay, so your brokerage fee is very high. So that's the reason you could cut down on your profit significantly, or you could have a higher loss, okay, than they actually are, right? So that's the reason trading in futures is not advisable during the first year of your trading career. Okay, many thanks for watching my video. My next video topic would be basics of option. There I would be talking about the call option, put option, what are the strike prices, what are the spot price, option chain in detail, what are open interest in options, what are the expiration date, option premium. I will be talking about in the money, out of the money, at the money. So many thanks for watching this video. I will be soon coming up with my another video on options. Thank you very much.